All right, so welcome everybody to another Friday discussion. So we are talking about markets in the context of the Iran-Israel conflict. So what we were talking before we started recording is that how bad this conflict can become and what will be the market reaction. What I mainly wanted to discuss is, and which let's share the chart. And one thing which I would like to show is sometimes market actually preempts those things, which I was looking at the chart and which is very interesting. Let me tell you. If you see from April, this uptrend, this was broken by Wednesday. So basically, we did talk last couple of weeks, we were talking about, we have been kind of stalling very close to all-time high. We were grinding upwards, but we were tired. And this we discussed last week also, that the markets are kind of run up. Now, what is the backdrop? The backdrop is that trade war is still on. July is coming, there is a new deadline. There is no deals achieved. There is one or two small news here and there that some alignment has been achieved, but that is still a hopeful situation. There's no real conflict resolution here. So market was already looking tired. We got a great CPI number. It did not change any probability of changing any rate cut expectation. So if you see, this is the big, so if we zoom in, this is the big drop you're seeing here on Thursday after market, which is because of the conflict. But if you see, the trend line was already broken and we had already been struggling. So we are so close to all-time high. That is a question now. Why would, what would take it? Either you have to break out or you have to go back and correct. Now, there is nothing, no news, which is helping us break out. And this is interesting that everything is same. Like if you look at NASDAQ, very similar. We had already broken down from this trend line and we were already, we had a huge period of consolidation, which is basically not moving as steep as we had earlier. So this is where in the backdrop, while I can understand that we can always call the reaction. And if you see after this drop after hours, the reaction was very muted to the conflict also. We are not seeing a huge drop. We are not seeing any major reaction. And then I think we were discussing even in our WhatsApp group, the biggest thing would be the oil market. Now, that is where I think, because oil market is directly correlated, Iran is a big supplier of oil. This would be ideal to check the panic level in the market. And if you see, analysts also are talking about the oil going very high because of this conflict. And the scenario is, as you know, that there is a Strait of Hormuz, which controls a big chunk of like 20 to 30% of oil supplies go through that, which are not Iranian supplies, which are the whole Middle East supplies, which is very much next to Iran. So initial reaction to that was oil went up to 77. And if you see right now, we are fairly muted from that also. So we are basically down to 73. Yes, it is elevated, which is fair because there is an uncertainty. Biggest issue is that we are talking about a weekend where markets will be closed and things can escalate. So that is where we are seeing there is some escalation in oil prices. Not, I would, again, if I have to make a guess, $80 is the price. Where if we see last time also around this, we had kind of made a top in January. And if this breaks above 80, that means the market is panicking and the situation is getting worse. So I would say, if you want to track this conflict, the one indicator you should look at is oil prices, which is one thing which will give you a good idea of how concerned market is. Then what is usually in any new conflict, gold gets helped. But again, if you look at technically, it was ready to go continue its bull run. We had already talked about the breakout. Even after breakout on the same trend line, it went and took support. And it had way before this conflict emerged, we were already on the way up. So this is just a continuation of a trend, which is the gold is being accumulated right now by the countries and so on. And that is getting, of course, the traders love to move the price up when any conflict happens. So this is where we are. Again, now let's forget about the conflict. We already discussed it, that this has one impact. This is giving market reasons to correct, which is probably a healthy correction after the run-up. And then we have to look at the yields, which is, what is the huge, we are still grinding down at a bigger picture level while, yes, they spiked up a little bit. So in other words, while gold is going up, while some of these things are, there's a money coming out of the risk assets as kind of a insurance against what can happen over weekend or next week. you are seeing that US Treasuries are definitely not the choice, which is a worrying sign. Usually, Treasury used to go up in uncertainty, and this is what I would be watching. If the yields not correct here, if the market keeps correcting and we see yields also going up, that will become a slight concern that US dollar, it's kind of a indirect note to us that markets are losing interest in buying US Treasury when there is uncertainty. So that means even when they're running off the risk assets, they are not going into US Treasury. But still, the concern is not there because we have already seen that we are not breaking out of 4.67%, which we had originally marked as our 4.7% is my personal monitor, where I will start worrying about this factor, which has a huge impact on the basic bull run. Bitcoin, I think a lot of people have been talking about whether it is why it is not behaving as gold. Let's preempt that question and let me be very clear. Bitcoin is not exactly like gold, while we keep comparing because it's easy to compare against gold with a digital gold narrative. Remember that Bitcoin inflows are still considered risk assets. There's still a very heavy correlation with the stocks which are listed like corporate treasuries. There's a very high correlation with ETF inflows, where ETFs are again a stock component. A lot of money overlap is there. And secondly, most of the assets, like, there is always this risk off trade impacts Bitcoin. But what we need to watch here is we are, even in the last correction, when we broke down, this is mostly a consolidation move between this range. As we have always seen, so let's actually zoom out because it's very interesting and we have been talking about it to the subscribers also for a very long time. It's very, very clear pattern if you see. Usually it consolidates for a long time, it breaks out, consolidates again, sometimes it corrects more, which happened in April, and then it creates a new pattern. Right now, we are at least, what we are very clearly seeing is, don't look at very short term. What we are seeing very clearly is that the buying support is ultimately above in 100 and 101K area, which we had been talking about for last 2-3 weeks. I have not changed this line. And if you see, we are consolidating right below all-time high and this line. So this is where we call it sideways move. So Bitcoin is in a sideways move. We have to continue watching how the supply gets absorbed in this region and when the next move happens. But overall, coming back to the market, I would say, I will just conclude by saying that, yes, this conflict has created this correction, but it's not unlike any other correction which happened a week before or 10 days before. In fact, those were even steeper if you look at even May, when there was no specific concerns like these. So what I'm trying to highlight here is this is a very much a market expectation that we were struggling here. Whether this conflicts become bigger, at this moment, market is not too worried. Otherwise, we would have corrected more. And I think we have to watch gold, oil, I would say, as our major indicator of how concerned market is about the impact on the overall economy. So I will take a few quick questions after this, but let me know what you guys are feeling about it. I see a quick question on the chat. So it says, it's a geopolitical question about China. I think we had talked about before that we started recording if Iran can get support from China. And we had talked about how, China has not shown any intent and they are still not willing to stake the claim for the superpower which the US is already preparing against. So I would say the comment here is that whether China can take Taiwan, yes, the conflict can start in multiple places. That's what you would have to worry about. But I think in general, right now, this conflict is still very much limited, where nobody else has come. That's what we concluded even before we started recording. There's another question here. If there is any comment, okay, there's a question about the charts I was showing. So that thick green line is the 200-day moving average, which we have discussed multiple times in this call. Basically, that is considered a key trend shift, like whether we are in uptrend or downtrend. Usually, 200-day moving average is a very popular tracking of where we are. So we have been trading above that for quite some time. So we have stopped tracking it right now. But yes, that will be usually that is going to 200-day moving average will turn out to be the support in any kind of corrections. So that's why we keep it on there. But I think most of the places it's not relevant anymore because we are trading way above. We are more closer to all-time highs than we are, testing any support levels down. So that's where the market condition is. Again, I would say feel free to put your question in the chat, or you can unmute yourself and ask. We are recording, so if you don't want to state your name while asking question, that is all right. Other than that, I think a few questions I would just take which are preempted. Some people send me one-to-one, so let me explain those. There is always this concern about how do you handle this volatility, like when you have these kind of war breaking out. So first thing I always say is that means we have already taken a lot of steam out in April with all the where people were talking about hitting new lows, and April was very pessimistic. When you're coming off that pessimistic time, usually people are always late. That is means based on my macro studies and money flow studies over 10 to 20 years. Remember that money after a big event like April, what happened? Usually the risk off is the theme already, and we only had 1 month of recovery. So the as we call it, there's a muscle memory which market builds. So it's very rare to have a steep downfall even in a worst case situation because of the muscle memory of low risk. So that is where we are right now. So I think, yes, there will be corrections which will be healthy. But even if, let's say, a big war breakout, so this was a question I'm getting in one-to-one messages and so on. But let me tell you, I would be more concerned if it was March situation where we were in all-time high, we were riding high on a optimistic long rally. But because we have already taken a lot of steam out, a lot of leverage out in April, yes, it has built up again. Yes, the correction is due, but it's not as bad as it used to be. And if you may have seen a lot of updates through last couple of months, this has been retail-led rally. It is not like there is a huge leverage in the system with hedge funds and so on. In fact, they were net short all through April. Even when the recovery happened, they were still net short. So a lot of professional investors are still not in a very high risk on position. So that is another thing I would say, based on all the reports we are seeing from analysts, it's not a risky situation, even if this conflict evolves over time. While yes, another like 5% drop is not a big deal after we have recovered so much, like 20% from all the way from the April bottoms. Yeah, go ahead. So you can unmute yourself.
Oh, can you hear me?
Yes, we can.
Yeah, thank you. Quick question. So you mentioned there could be a correction, or we should expect some. Is this notion coming from like technicals or fundamentals? Because I feel like that most of the like PE ratios for the big companies like Google, Meta, Nvidia, they seem to be okay. The earnings are doing fine. So overall, consumer sentiment also doesn't seem that bad, right? So those kind of indicators seem okay. Maybe this notion of correction is coming from looking at technicals, but I'm just a noob question.
So no, I think it's not definitely not a bad question. Let me tell you that there are a lot of people who have been actually pointing to that last 12 months of P ratios and CAPE ratios and whatnot are at a much higher zone versus historical 10-year levels, right? So it's probably nowadays we have got used to the high PE ratios. Means PE ratios of S&P 500 used to be below 20. Nowadays it's in mid 20s or late 20s also. We consider as a good enough. Question is usually what is the right P ratio? I don't engage in those because, as we always say, market is run by money flow more than valuations. Those days are gone, and unfortunately, the books still talk about valuations. I won't worry about valuations. It's mostly about what if people are willing to pay for Nvidia's or Apple and Mag 7 of the world. Their valuation, if you go historically, they are at a level where nobody can justify. If you drop by 25% here, people will still justify that they are above historical averages. So usually the question is, what is the growth outlook? I think why means if you see Nvidia was nobody was buying it at, in April at $90 or even below 100. It was correcting over and over again. Even it was not able to catch up when S&P 500 caught up. It only has caught up when people got AI trade confirmation again. when the earnings analysis came, when Nvidia really talked about, how they went to this trip to Middle East, and Trump took them along, and everybody confirmed that they want to still invest. So market works on projections more than actual hard data, and the PE ratios will expand when there is a growth expectation optimism starts. Um, Now, to answer your question, why the correction we are expecting, I'm not suggesting I'm expecting a correction. I'm saying market was looking tired, and the trigger for breaking out all-time high is going to be something fundamental changing. Tax bill was supposed to be that, which hit a hiccup after the whole Elon Musk drama, and how the whole Republican group reacted after that. I don't know what kind of deals they have achieved with Musk, that now he has kind of taken back his comments and whatnot. But basically, what we are seeing is that will be one trigger if the tax bill is confirmed. Right now, market sees that as uncertain after the drama of Elon Musk and Trump. Uh, Trade deals are not moving forward, which is a big hiccup, because there is a July coming where all the deadlines of exemptions go away. While the reason why markets are not corrected because of those news also is because Besant and many people in the cabinet have made comments that don't worry. They are very worried about treasury market totally going out of whack again. So they already made statements that we may extend the exemptions because stocks are going well. So they are actually seeding this news while the resolution is not happening. So market is rightly going sideways because we have taken the worst case out, which we discussed in April all this time, that worst case is already priced in. We went back towards all-time high. Now, fundamentally, we need to see actual results for market to justify higher valuations, even though we can always debate about what is the right PE valuation. But I think you're right that they are not obscenely expensive. Stocks, if you believe in growth, none of these tech stocks are very, very expensive right now. If you look at 2 to 3 year history, if you look at 10 to 15 year history, people will be able to justify how they are super expensive. So again, whether you like, I'm a believer that valuations don't remain same as the world and the money supply is growing. P ratios will stay higher. That's how we talk about at a macro level. Some other analysts will talk about how we are historically at a high PE ratio. So I don't think there's ever going to be a consensus what is the right PE ratio. But based on sentiment, I would say the breakouts can happen when there is a real resolution. And that I keep repeating that even in April, when the drop happened, I was highlighting these two positives which are expected. One is the trade deals, and the second is tax bill. I would say at a macro level, these two are still the major catalysts for breaking all-time highs. And if you see from here, we are probably we almost touched like 1.5% of all-time high on both Nasdaq and SPX in last 2 days. So any of these things can take us to new highs. And when you are at all-time highs, you cannot say that valuations are low. Means at least consensus will be people will be worried. So either way, right now market was looking to lose some steam. This conflict is one good reason why some people are taking risk off. They are taking some chips off the table. The question, and who is the beneficiary? If you see, gold is in a bull run, it's continuing. Bitcoin is absorbing a lot of capital. If you see the supply of Bitcoin, and how much demand gold is generating, what I think is interesting is now we have these four asset classes: stocks, bond, Bitcoin, and gold. And people are just debating what's the right allocation. And this can be a great discussion, but overall what we are trying to highlight here is the equity will need a catalyst. uh, Corrections are not going to be deep because we already left out some steam in April, so we are not over leveraged. So now it's a question of how bad, like for example, if oil breaks above 80 because of any major conflict escalation, there will be some more risk off the table, because you're talking about a big inflation input. Like, if we were talking about $60 oil and suddenly we have $80 oil, people will start projecting that inflation, what will be the impact on inflation for next 3 months. So this can trigger some higher correction, because already there's no rate cut coming from Fed. And if there is any uptick in inflation, basically you are stuck for higher for longer. Higher for longer narrative is not good for equity. So all these things are combining us to an indecision zone right now, I would say, rather than expecting a big correction.
Thank you.
So again, Means again, as I said, I may have to drop out in another 5 to 10 minutes today. So let's take a couple more quick questions if somebody has. But overall, I think we are still, remember, means the news cycle can become very crazy sometimes. Like, for example, today, I don't know, means I usually don't watch the news, but I'm sure people must be talking about how this conflict can really do damage to the market because we are already 1 to 2% down today. So basic idea here I would like to highlight is we are very much on the top end of the market valuations. If you look at historic levels, we are very close to all-time high even now. It can hardly take 1 to 2 days of good rally to reach those. So think about your risk assets. I would say this is the right time to stay hedged till the catalysts resolve themselves, because we have to see a real outcome of these trade deals, because that is where I think right now we are hearing some news about some basic things with India or with China, but we have not seen actual resolution on either of the trade deals. And the second problem is that right now, the biggest thing which everybody's speculating is how long Fed will take to start cutting again, because we are sitting on very high rate. Remember that 4.25% rate is a restrictive level. Means our real rates are very high right now versus where the inflation is. So it is still not helping general growth, which is purely based on soft data. Soft data is that all these policy changes are going to create huge inflation in future. So this is where I think people are like long yields are still in control because that the hard data is good. As soon as the hard data goes bad, like if inflation starts going up for any reason, this is a very volatile situation because you can have 10-year yields hitting 5%. Those create very big pressure on the valuation. So P ratios is very, very much one aspect. When the big money allocates, they look at what is the risk-free rate. Today, P ratio is actually high if you compare with the risk rate, because these level of P ratios were common when the 10-year was at 3% versus 4.5%. So you need to also compare what is the risk-free rate and why should somebody be on a risk-on trade for a certain P ratio. So these are the things which need a little more detailed discussion, maybe a topic of some of our in-person workshops. And this is one thing which I covered very heavily in 2022. Let me repeat it if people were not there in 2023, actually in January event. One historical data point. Uh, in 2022, I think we are in Bay Area, most of us, and a lot of people were invested in this SaaS companies. And I'm sure if you were invested, you must have seen 70, 80, 85% drawdowns. Those companies had nothing fundamentally changing. All of them were loss-making companies always, even when they were higher priced. Their growth rates were still 100%, like 70% growth, 80% growth year on year. And people used to come and tell me like why they've corrected 80% when their revenue went up 100% this year. So the reason was that when you're talking about growth, it's purely you are willing to invest in growth when their interest rates are very low because your risk-free return is very low. As the rates started going up in 2022, the trade was over. So people started dumping them. This is where I think people don't forget that valuation have a very different meaning in a certain rate environments. That's why we watch the bond yields. That's why we watch the 10-year, 20-year long-term yields, because you have to always look from the lens of what is the alternate for a money allocator and why should I pay that valuation if my rate of risk-free return is getting better and better every day. All right, so I see one quick question. Some companies, for example, Walmart are talking about issuing stablecoin. Should we be concerned? I would say stablecoin growth is a very big positive for US dollar. And why? Let me explain you. If you see, as China, as many other countries are dumping US Treasury, who is the buyer? The buyers are tethers of the world and the circle of the world, basically Coinbase of the world, who are buying Treasury for every growth on stablecoins. If you are a stablecoin issuer, basically you are bringing more and more money on chain. You are bringing more and money on blockchain. It's only a technology advancement. It's helping a lot. And most importantly, this is going to be a new money supply, which is going to be moving faster. So as we call it, any economy grow faster when there's velocity of money is good. Like US was probably one of the slowest money transfer place. If you compare with the China and the India of the world, where you can transfer money like instantaneously, big amounts. Stable coins are the thing which you need, where you can settle huge amounts. Even today, when you look at Zelle or other, PayPal and Venmo kind of people compare against, oh, we already have instant transfers. But remember, there are limits to that. You cannot send $50,000 over those channels. But once you have stable coins, you will be able to settle any amount because there is no limit on those. So a lot of companies are moving to stable coins. But what is the impact? The impact is all these issuers of stablecoin, they are backed by US Treasury ultimately. So this is going to be the biggest consumer of US Treasury in next 5 to 10 years. If you see even the testimony of Scott Bessent, he was talking about a projection of a couple of $1 trillion of stablecoin economy. So it is intentional. I don't see any reason to be concerned. In fact, this is one thing which will save US dollars. The US dollar hegemony is going to stay because as it happened, USD is the only stable coin which is growing. A lot of companies have issued euro and other stable coins. China has not even started issuing stable coins. And even if they do, that's the benefit of being existing reserve currency, where everybody is already pretty much documenting all their accounts in dollars. And when they move to stable coin, already US dollar is securing next, I would say hundreds of years of future. So it's in best interest of US and US dollar economies to grow USD and stablecoin. The risk will be when China launches or somebody else launches which become bigger. At this moment, the biggest stablecoins, even in China, if you see, if you look at Binance or any other exchanges which are very popular in China in crypto world, they're using USDT, which is USD based stablecoin. So that is actually going to be very beneficial for US and US companies and for everybody invested in US. So I would just wrap it up here then. I think it was a good question and a great discussion. So as I said, we'll talk about it next week, and thanks a lot. Have a great weekend, and let's see how the market evolves next week with this conflict, because over the weekend we will see some progress. Means just to summarize, we talked about this conflict should remain local, but we are seeing much bigger responses coming from Iran, and this is definitely biggest of Iran-Israel conflict till now. But whether it blows up, just watch the oil prices, just watch what else market panics about, because oil is traded most of the time. So you will see over the weekend some price moves. I think that would tell us how the market will open on Monday. But even if it happens, my just simple thing is remember, this is all noise. We have seen bigger drops. We have seen a lot of money flow, money on sidelines, which is coming in. So I think we just have to remain hedged to take advantage of these moves where we believe that we may go sideways with some correction and buying back again. So you can use options, and that's what we keep recommending. So do tune in for those discussions, and a reminder also that we have this advanced options group, which was created after last couple of workshops. So feel free to come in and discuss there, because that's pretty interesting, I think, learning happening there. I see a lot of new people who are trying out these options. So do come in, and this is forming a good community there as well. So thanks everyone. Have a good weekend. Bye bye.